Hello, I'm Ann Voller. I'm the Vice President of Executive Recruiting and College Relations for Macy's, Inc., and it's my honor to introduce our next speakers. So I'll begin with introducing Mr. Jerry Nechleba, who's the CEO of 4R Systems. 4R helps leading retailers, including the Vitamin Shoppe, Family Dollar stores, and Crate & Barrel, drive significant profit improvement by applying an investment approach to their inventory and supply chains. What's not on his bio that's interesting to note is that Jerry studied at MIT to be an astrophysicist, but he has assured me this is a retail presentation, and those of us that never took physics ever are going to be able to follow just fine. Also co-presenting is Mr. Michael Archbold, who's the EVP, COO, and CFO of the Vitamin Shoppe. Mr. Archbold has held over 25 years of experience in retail industry across several facets of our business. He's held CFO positions at Saks Fifth Avenue, AutoZone, and Barnes & Noble. He has just recently celebrated 25 years of marriage, and he has 4 children, and he says you can do it all. So join me in welcoming Mr. Jerry Nechleba and Mr. Michael Archbold.
And actually, there was a little bit of a change from when that slide was probably put together to today, which is, I think earlier this week it was formal, but Mike was promoted to President and Chief Operating Officer.
Thank you.
So I acknowledge that. And we're going to talk a little bit about making money in retail and investment perspective. There's been an awful lot of talk about reaching the customer and the complexity of the consumer market and the complexity of the product markets out there. And ultimately, it comes down to making some money. So we thought we'd have a little dialogue here and take advantage of Mike's experience in retail to talk a little bit about the making money part of retail.
All right. Well, we already were so nicely introduced by Mary, but I'm the President and Chief Operating Officer of Vitamin Shoppe. I have been in a number of other places in retail, so I've seen a number of different formats, different approaches to retail. As Mary said, 25 years in retail, and thrilled to be here and share some learnings over those 25 years with the group.
And I'm with 4R, and Mike is a wonderful client of ours, and we're going to talk again about this. So let's start with Mike talking a little bit about this slide, which takes 2 seconds.
We will not talk about the safe harbor, it just is there.
Just in case he says something that's forward-looking.
Okay, so who's Vitamin Shoppe? If you don't know us, we're the leading specialty retailer in the vitamin, mineral, and supplement space. We are the fastest growing retailer in the space, having opened 184 stores just over the last 4 years. We have 484 stores today in 38 states and do about 10% of our business online in addition. We recently took the company public in October of 2009 and are traded on the New York Stock Exchange. So we were fortunate enough to break the ice and be one of the first retail IPOs after the dearth of retail IPOs back from 07 into 09.
And for our systems, we work with retailers. Some of our clients, you can see the logos. Barber Turf is a wonderful client over at Crate & Barrel. Vitamin Shoppe's a great client. Family Dollar stores, so very different formats in Burlington Co. And we help retailers do something we call profit optimizing their inventory and their supply chain. How much to buy, where to put it, and when. And we'll talk a little bit about this process as we move forward. When you say investment view of retail, you typically think of the stock market, right? Investing in retail. But we're not going to be talking about this kind of stock.
Really going to be talking about this kind of stock. So in our example in Vitamin Shoppe, our typical small box specialty retailer has 8,000 SKUs in that store. So we really differentiate ourselves on being the most complete and authoritative in the space. And then, of course, having the most knowledgeable enthusiasts to be able to engage customers in a one-to-one experience about their unique health and wellness needs. But what we're going to talk about today is how do we actually figure out how to stay in stock, what's the right level of stock to have for 8,000 SKUs across 484 stores today.
So if you think about it, retailers are investors. We invest money into product so we can sell it to the consumer. And over the last day or so, we've been talking an awful lot about the product and the creation of the product and the sale of the product to the customer, the understanding of the customer. But we're going to talk about the third leg, which is the money, because if you think about it, in retail, we actually connect three markets together. We connect a product market, a consumer market, and ultimately a financial market together. And it's really the symbiosis between those three markets and how we manage that wheel that really drives our profitability. So as I said, we've talked a lot about, over the last few days, products and consumers and the changing marketplaces and the complexity of that. But if we really go back and understand retail at its roots, this is a graphic from the roots. I don't know how much retail history is taught in the program, but if you go back to the roots of retail in the United States, there was somebody called the Yankee Peddler. And this was even pre-Revolutionary War, but basically they would carry around a couple of baskets. They would go to a market, a source market, if you will, and they would buy goods, and then they would go travel around to farms and people and sell them things. So at the root, that's pretty much what we do, but it has become a lot more complicated. Our customers are different. You know, they're young, they're older, they're emerging families, there are different lifestyles involved, and so that's certainly created a lot of challenges. And they have diverse needs. You know, we need transportation, we need food, we need clothing, we need lifestyle, we need good health. I could have a million pictures up here, but I think everybody understands that when we go out there, one of the great things about the American consumer market is that there's a lot of stuff out there for you to have. And they're fulfilled in a lot of different places, right? On the upper right is, I think, Macy's, probably that's Union Square in San Francisco. On the upper left is Crate & Barrel on North Michigan. There's a Vitamin Shoppe store, but they're all over. Hess convenience stores. You've got drive-up fast food. You've got club stores, lots of different formats, even airports, duty-free shopping, for example. And as we've been talking about, I think, a lot in places that we're just getting to, online, Facebook, Twitter, iPads. So it's a very complex market. All the companies that are here today are out there to meet that demand and meet that need. And for everyone that's here today, there are really a whole bunch more. I mean, that's actually an A to Z. And I got to tell you, X is a hard one to find a retailer for. X10 home gadgets is what I could come up with. But that's actually, there's every letter of the alphabet up there. And you know, for every letter, there's another 100 or 2 out there probably. So as we've heard from many at the conference, the consumer marketplace is very complex. And the product market that accompanies it is just as complex. So what I'd like to do, and what Mike and I have talked about, is to talk in more detail about the uniqueness. And Mike's experience across very different businesses and formats, I think you can really talk to the different ways that retailers connect with their market.
So having seen a couple of different models, it's interesting and watching the evolution, and you've heard a lot about it today, about how to really engage the customers. So whether that was years ago at Saks Fifth Avenue, where what they called the 9-box grid was created, which was kind of a classic. If you've studied retail long enough, you know the good, better, best kind of delineation, and then kind of came up with a customer that epitomizes different customer segments for them. So whether it was the modern segment, which was classified as kind of the uptown segment, your classic, or known as your Park Avenue customer, or your downtown Soho type of customer. So they created a 9-box grid to kind of figure out how to address that customer. At Vitamin Shoppe, we took things to a further level originally, where we actually understood our customers at the 6D Claritas psychographic levels to actually understand the predictability of the behavior. But more important is, where's it going? Because to Susan's point earlier, it's really about personalization now. So as you students who are coming out and going into retail, from this point forward, the whole segmentation thing is going to be about segments of one. It really is. So everything is changing in terms of the way that we engage our customers. So that's going to help us to determine what product we're going to want, even where we're going to want it. But what it doesn't figure out for us is how to actually get it there and stay in stock. So that's kind of what we're going to talk about next.
So retail's evolved, and as Mike's talked to, there's a lot of complexity. Everybody here has talked about a lot of complexity, and we're talking about the financial markets. And I guess, Mike, you've been a CFO for a private equity-backed company, for a public company. When you talk to the financial markets, is their needs as complex as the consumer market?
their needs are probably a lot simpler. So they're going to be looking at what are the returns, because they need a return for their investment. So whether that's a private equity firm or whether it's a public company shareholder, they're looking for the same thing. We changed the vernacular and around a little bit. So we talk about EBITDA when you're a private company. You're going to talk more about EPS and operating margins when you're a public company. But in the end, it's all about how much am I investing and what's the return that I'm going to get.
So if you really look at it, making money is still pretty much the goal. And our scorecard at the end is, do we have more money than we started by a substantial amount and a good return? And to kind of reinforce the point, I actually was in New York last week, and I was sitting down with Deborah Weinswig, who's the senior retail analyst for Broadlines at Citigroup. And I asked her to talk a little bit about the investment world's view of retail, right? And what's important to them. So if you bear with us for a minute or so, I'll apologize to Deborah. We had a really nice long conversation, but I kind of distilled this down to a couple of points and bullets.
So when we think about retailers, we look at it, a good retailer invests in a lot of things. And a few of those are great real estate, great people, right? Because you want great customer service in your stores, a great management team. Mm-hmm. But one of the things, obviously, that's new and exciting, and one of the reasons that a customer visits a store is what's on the selling floor each and every day. So inventory management is obviously very important. Well, I mean, my thing is when I sit down with a client, which I do almost every day, is you just ask them how many times have you been into a retailer, and have they not had what you wanted? I mean, I will tell you for myself, it's about 100%. You find something you like, which I can do pretty easily, and they don't have your size, and so I think that is an unmet need. And even in the consumables category, which obviously the turns are higher, but also you've got more trucks coming in, you've got a significant opportunity, I think, to drive sales, but also to drive profitability and drive earnings. Absolutely, and I think this is key to bottom line. Because at the end of the day, from an analyst perspective, what we care about once a quarter is when retailers report earnings.
So when we really look at it, we have a very complicated marketplace that we deal with on the consumer and product side. Because it is complex, there's many consumers with many needs. But on the investment side or on the financing side of the marketplace, we have a very simple need. They like to see earnings out of it. And if you really look at retail, it's the glue of commerce. It connects capital markets and consumer markets. It's symbiotic. It actually translates the assets of one market into the needs of the other. So it turns capital into products to satisfy consumer needs, and it turns product into profits to satisfy investor needs. And to be good glue, retailers need to create and fulfill a customer's desire to buy, deliver great value, and make money doing it. And it's the fulfillment part that I think is an important thing of what we're going to talk about for the next few slides, because we've really raised the bar in retail with all of the communication, all of the personalization, all of the offers that we offer to the consumer. And yet we only monetize that demand when we actually put a product into a person's hands. And by putting that product into a person's hands, that's where we make our money. And the interesting thing is if we have a sale and say, come and get this, and then the consumer comes into the store and it's no longer there, that disappoints the consumer. And in today's world, they all have a megaphone, whether it be Facebook, Twitter, or whatever, and they can say, went to the sale, didn't have it. How could they advertise that deal? Didn't they realize a lot of people would want that product? So it's become more and more important, not just from the standpoint of monetization, but also from the standpoint of customer service, to be in stock and to make money.
So just to set up the discussion of the process that Vitamin Shoppe went through, I'll go back to 2007 and what Vitamin Shoppe was doing, and for the most part has continued to do. We're in a large and growing market. The market's about a $26 billion industry, and importantly has grown through the economic cycle. So one of the few sectors that grew right through the cycle. And we differentiated ourselves by being the most complete and authoritative, having those 8,000 SKUs in a typical store, very different real estate strategy than anybody else out there, and then driving knowledge. And we've spent a lot of time investing in proprietary knowledge-based systems to really drive the training within our stores. We had a proven store model that worked across the entire country, and we were ready to roll out, and we were preparing for our initial public offering. On the weakness side, it's interesting because right now this says poor in stock and service. I can only tell you that with the advantage of hindsight, because at the time we considered ourselves best of breed, best in class, better all of our competitors that were out there. However, we didn't know how good can be. So we measured our in-stock, but we didn't do as well as we could have done. But again, we were best in the class that was out there. So we didn't have the right inventory in the right place all the time. And having 8,000 SKUs with a typical box having 40% of those SKUs with an on-hand of 1, it becomes really hard to stay in stock on those items. So inventory turn had remained flat, about 3 times turns, which for a high assortment type of business, not that unusual. Again, we thought we were best in breed. We didn't know that we actually had a weakness there. The challenge that we put out to ourselves in working with 4R systems was how good can that inventory productivity actually get? And we needed to hold ourselves to the same type of criteria that we hold every other investment within Vitamin Shoppe too. So we hold ourselves to strong return criteria on every new store that we open. We spend a lot of time building systems that predictably model what the productivity is going to be out of a new store. What we hadn't done is figure out how to better predictively model what we needed for the inventory in each of those stores. Knowing we could do it, especially as a private company, every dollar that we could save in working capital was going to reduce debt, was going to increase our enterprise value, which meant to a private equity guy, that was his equity. So what did we do? We changed the way that we managed the inventory. We stopped managing it to simple heuristics like what was your turn and what was your in-stock. We actually worked with the folks at 4R to actually develop that same type of investment criteria, the same discipline around putting inventory in stores. How did we do that? We actually worked with them to assign a cost of capital. The cost of capital was assigned actually differently at individual SKU levels. We looked at our inventory across 484 stores, and we actually wound up developing a model with 4R where every single week the system reprojects the demand stream for 484 stores times 8,000 SKUs, so close to 4 million store SKU combinations that are redone the demand stream every single week. And then importantly, it's not just the demand stream, it's also the supply stream. So we had to spend a lot of time understanding not only the delivery time that it would take to get from our distribution to our stores, but the variability of that delivery time, whether it be weather that threw it off, even the variability of the lead time from our vendors, who were not always so perfect about getting in stock. So building all of that into a system to predictably model what was actually going to happen, how do we actually get ourselves to a better level of in-stock, that was the challenge that we laid out for 4R.
Actually, I think, this for some reason it hangs on this chart. So we have a technical glitch. The AV guys are going to reboot us at the next slide. I don't know. Okay. So I'm going to talk for a few minutes about an investment approach to inventory. Because if you think about it, we use a term in retail called safety stock. And if you really think about what safety stock is, it's insurance. And we all know that when you buy insurance, you buy a certain value of insurance and you pay a certain premium. And we deal with insurance, the cost of it and the benefit in dollars. And what we're basically saying in inventory is that if we could monetize this decision, and we could understand how we invest into our inventory and how to make that investment better, we could make more money. So let's talk about, if we have no inventory, what do we know? Inventory didn't cost us very much, right? But the lost sales and lost margin is very large. Everybody who shows up in our store can't get what they came for. They won't come back to the store, and we lose a lot of sales. So we could put a lot of inventory in the store, and that would cost us an awful lot of money. And we know at the top we'd have very low lost sales and margin dollars. So that's not a great solution because we turn really slow and we wouldn't be very productive. So the inventory approach, if you look at those two extremes, there are two key costs that drive the value of your inventory. One is the holding cost. How much does it cost for me to hold it? And the other is, how much do I lose in margin if I don't happen to have it? And what we've found is that the most profit is made when you minimize those two costs. So how does that look graphically? Basically, as we add inventory upward, where the blue line, which is inventory cost, is growing pretty linearly. Double the inventory, you got twice as much money tied up. The red bars, which is lost sales, you're reducing it. So the first unit of inventory is very productive because it almost always gets sold and you get all the margin dollars. As you start to add more inventory in, you lower lost sales. But at some point, the cost of more inventory that you're adding is more than you're going to reduce lost sales. And that low point there, where the lowest cost is, happens to be the highest profit. So now you can do this at the chain, you can do this in a category, but you can also do it for every item and in every store. So that's what Vitamin Shoppe did, is we figured out the most profitable inventory level, not the one that would turn highest, not the one that would generate in stock. Because if you think about it, if I've got two products, one with an 80% gross margin and the other with a 60% gross margin, the bet is very different. The investment cost is lower on a high gross margin item, and the loss of lost margin is different. So you have to weight by margin in order to get to the right answer. So that's what Vitamin Shoppe did. They rolled this out across the entire chain, and I'll have Mike talk a little bit about what happened.
So as we rolled this out, one of the most amazing things that happened, okay, yes, that heuristic that we said we weren't going to look at, well, it got better, but so the inventory turns improved. But more importantly than that, our in-stock rates actually went up. So, and this is customer-facing in-stock. So the probability of us having the item that the customer wanted when they wanted it went up from in the low 90s to 96.8 as of our last quarterly conference call. So inventory levels went up. We actually were able to continue to roll out our stores. We had 10% unit growth, mid-single-digit comp growth, and inventory levels were flat. Actually, in the first year, they were down. So we actually had lower inventory dollars, significantly higher sales, higher in-stocks, better customer satisfaction, and we did it all with less inventory. So it really was an amazing process. And in fact, it wasn't just about reducing inventory, importantly. Jerry's model actually predicted, first and foremost, that we needed to add a lot of inventory to a lot of places. Okay, and me in my prior hat, because I'm both chief operating officer and was chief financial officer, I put on my finance hat and said, well, all those ads would be a problem. So we actually restricted and said, you know what, subtract first, then you get the right to add. And we did it, and we had a very disciplined approach to it and rolled this out. But the results were absolutely incredible. Higher sales, supporting higher unit growth and comps, higher in-stock to the customer, all with less dollars invested in our inventory. Of course, Jerry ends this with, we went public, as if that was the sole thing that did it, but, you know, but it certainly did help for us to be able to go public. So.
Thanks. So it's a very simple story. If we start to think about our inventory as an investment and measure it as an invested cost and the return we get out of it, and move a little bit towards that, away from just saying, because if you look at how inventory is usually modeled and managed in retail, it's a question, it's not an answer. You go to senior management and you say, Mike, what in stock do you think we should have? And you say, geez, you know, in our wisdom and stuff, I think 98% looks really pretty good. Let's target 98% in stock. So you dial that all in, and then you look at the results and say, well, maybe what we need to do is take our best products and have a higher in-stock rate, and we've got these other products, and these best stores should have a different rate. And it becomes basically an iteration where you're using your business to seek out a better answer. So there is a way of modeling that and getting to a better answer. And I think, you know, this is a difficult room to talk to because, and it's a fun room to talk to because it's got retailers in the room and has students in the room. So we tried to have a wrap up and a conclusion for each of you. You know, for the retailers, an important part of buying is being a good investor. We certainly know that, buy low, sell high. But if you apply that same philosophy of being an investor into how you measure and manage your inventory and supply chains, you can drive a lot of profit and service. For the students, you know, as we've heard over the last day or so, retail is a complex and fascinating business that connects different markets. Hopefully we brought a light towards another market that retailers connect to, which is the financial markets. And that one key for in your career is in being a good retailer is also that you'll have to be a good investor, that's a really good discipline to have as well. So, thank you.
Thank you. Thank you.
Great
Open up
question.
for questions.
Hi, you had talked about developing the system to project the demand stream. Do you think that that would be effective for the clothing retail industry that has to deal with fads and trends?
Boy, I'll tell you, now I really understand what everybody talks about when saying you can't hear a darn thing from them.
Does the demand stream actually apply to the fashion side?
Yeah, actually, what's interesting, if you think about the notion of inventory as an investment, replenishment inventory is it's an awful lot like a bond. You invest capital into your replenishment inventory, and every week it pays you a coupon. You make a certain return. It turns out fashion items are actually like a stock option. You know, when you buy a stock option, you essentially buy the right to get a stock at a certain price, and at the end of the option period, it's worth very little. Well, that's exactly what happens with fashion. And fashion has high uncertainty, and part of the nature of this problem, what makes it difficult, is it's like going to Las Vegas. You're betting probabilities and outcomes. So by monetizing that and understanding and treating fashion goods like a stock option, you can actually make better investments or bets, if you will, on the quantities that you make. Because ultimately, retailers don't bet on the future price as much as they really, like the stock market does. You bet on demand and the uncertainty of demand, and how do you bet that better? Just a good question.
Thank you.
Just building on that, the other place that it also keys in is it's not just on the initial push that you might do on a fashion buy, but then as you might decide instead of pushing 100, you push 60, you hold back 40. That 40 can then be replenished based upon a demand stream as opposed to an anticipated demand stream like in the fashion side. So it's kind of a blend of the both.
At Crate and Barrel, for example, our firm sets inventory for the replenishment items, but we also allocate their seasonal items. And there, the balancing act is different because basically you're sunk money into your products. Your product margin isn't really as big an issue. What it is an arbitrage between sending a lot of product early. If you put in a lot of product early, you don't stock out at the beginning, but at the end of the season, you've got broken inventory where you've got some stores that broke and you could have had full margin sales, and you got other places you're marking down. So it's a tension between how fast and how late to push, and essentially maximizing the trajectory and the profitability of that trajectory of how you push items out, in addition to how you buy them. So.
Gentlemen, I think this is an excellent case study. Certainly the changes in your inventory levels would have some impact on some of the activities that take place in the stores, in particular the restocking cycles. And so I wonder if you could mention, were there changes in your case pack sizes that resulted from this, and how did you handle it? Or were there changes in the labor hours that were required to maintain in-stock position now that you had this better information?
Really good question. So the short answer is we didn't adjust either in the short term, primarily because on the deep assortment products, I said we had on-hands typically of 1, so 40% of our SKUs have an on-hand of 1. It didn't really change in terms of how we were actually stocking either in the stores or picking from the distribution center. And that's interesting in our model because our distribution center is actually designed for each pick. So most retailers, case pick, flow through, things like that. We actually design our distribution center to do each pick because of each of those SKUs in the stores having an on-hand typically of 1, or 40% of them having an on-hand of 1. The benefit to that is we actually have the same distribution center that services both the bricks and mortar retail as well as our e-commerce site, which is very unusual because it's generally a very different pick replenishment dynamic. So.
And to those points, one of our clients, for example, Family Dollar Stores, has a number of stores that are 800 miles away from their nearest distribution center, so they have a high cost of delivery. One of the things about monetizing these inventory levels and benefits is you can figure out if I deliver a store once every 2 weeks versus once a week, what is the differential inventory I need to carry and the cost of that inventory, and you can compare that to the delivery cycle. It turns out for a lot of rural stores, you should stock up a little higher and deliver less frequently, and frankly, that'll probably become a bigger deal with higher fuel costs. Relative to case packs, actually, Crate and Barrel had exactly that thing. What we found was that they had too much glass depth in a lot of their categories. So one of the things that Gordon and Barbara did was refixture the glass a little bit, reduce the amount, free up some space for a bigger assortment, put some in other categories. And then the implication actually was exactly case packs, because they were shipping in case packs of 24. And when you ship in case packs of 24, it was hard to set inventory right. So they actually went to inners, I think, of 6 inside, so they could actually replenish in smaller units. So that's all about dialing in the supply chain to feed this chemical reaction, because the chemical reaction that makes money in retail is buyer meets product. And if we can make that reaction more efficient, we make a lot more money. Great. Thank you all.
Thank you.